Sanjeev shall start?
Yes.
Yeah. Respected CA Sanjeev Singhal, the Central Council member and the chairman of the Committee for Members in Practice, and the panelists today and the speakers on the topic. The series is Navigating Recent Changes in Schedule 3 of the Companies Act 2013 and the Auditors Report. The panelists are none other than our beloved CA Manoj Fednesji, the Honorable Past President of ICAI, and CA Deepa Agarwal, CA Sudhir Soni, and CA Vijay Kumar Wadhwani. They are the panelists, all renowned panelists who are subject experts. So they don't need to go through the subject. So anytime, 24/7, anytime you can tap their brain, they will come out with the subject. So well, knowledgeable persons we have. Friends, before we start the presentation on the program proper, so I've been assigned a small job of introducing what are the schemes. I don't say welfare schemes, that are schemes for the profession which are available through the Committee for Members in Practice. The friends, as you know, we have been time and again telling that what are the schemes that we are having, what are the schemes we are negotiating, bringing it for the benefit of not only the committee for the members in practice, but also the members in industry also. This will be, once we utilize, everyone goes to that one and utilizes all the schemes, and there is a benefit out of that one, then only it gives immense satisfaction. Getting schemes is not a big thing, but we are there 24/7 will work for that, but you must utilize that. For that purpose, you must know what are the schemes available. We have got a very good portal called CMP Benefits at icr.org. You please visit the CMP Benefits portal. You have got plethora of benefits that were lined up. Just to make a mention of few of the things which are in book already. As you know, the medical insurance, what you have tied up with New India Assurance, and is a very good scheme with a highly discounted price, and a lot of benefits are available where you can insure the dependents also, which is not available in any other product which you get in the market. Similar life term insurance and personal accident insurance and non-life insurance also, motor vehicles and household insurance, all those things are there lined up. You please go through that one. And also banking, as a banking sector is concerned, we have got credit card facility through Bank of Baroda. We are trying to line up some more in very near future from other banks also. And as it is, we've got loan facility through State Bank of India and also Poonawalla Finance. You please go through that, and there are a lot of benefit where even is a facility is available for taking out a high cost loan also. So about the free software and tally discounted price for the new practitioners who are coming to the practice, and many softwares so which are freely available for the initial couple of years, and thereafter you have to pay a small amount of fee for the softwares. And the laptop scheme also, the HP and Lenovo want to have for the members in practice for the articles from the audit clerks also. So that's also a very good scheme. I request all of you to get benefit out of that. And I request the chairman, it's not proper for me to tell all the schemes. Whatever is in the progress now, and there's a lot of initiatives with the audit tool and also e-library. Before he starts the program, he'll take a couple of minutes to explain you what are in the pipeline for all of us. With this few little information, so I hand over the proceedings to an honorable chairman who is doing a lot of work in the Committee for Members in Practice. It has become one of the most active committees in the ICAI. Thanks to my chairman, Sanjeev Singhal. Over to Sanjeev Singhal now. Thank you very much,
Honorable Prasannaji, my co-chairman in the Committee for Member in Practice. As initiated by Prasannaji, the Committee for Member in Practice is taking a number of initiatives, and most of these benefits are available to not only the members in practice, but also members in industry. As he mentioned, we are in the process of coming out with an RFP for audit tool, which will be a game changer for the members in practice in India, and the whole world will watch it with curiosity, the kind of documentation tool we are going to provide to our members. We are also working on a data analytical tool. We are working on a digital library where our members will not need to take any subscription for accessing the income tax case laws, GST, transfer pricing, insolvency, bankruptcy cases, corporate law cases, etc. And all will be available to them through the digital learning hub. Similarly, we are also working on a practice management software, and we are working on a number of other welfare schemes. We have tied up with Bharat Law House for books at discounted prices. We are tied up with Ease My Trip for discounted travel. We have tied up with Samsung Electronics for discounted products. We are in negotiation with Apollo Hospital as well as Microsoft and many other schemes we are bringing for the benefit of our members as well as students. Friends, the topic for the day is navigating the changes in the Schedule 3 to the Companies Act 2013 and the Companies Auditor Report Order. These changes are fresh, and this is the first program by any committee of the Institute of Chartered Accountant of India. The idea was to take the members through all these changes, and I'm happy to share that more than 2,200 members have already joined, and the number is increasing. And we have we have a very eminent panel today. There'll be a technical presentation by Deepa Agrawal for about 40 minutes or so, and this will be followed up with a panel discussion where we have the three esteemed panelists, as is already introduced by my honorable co-chairman Prasanna ji, CA Manoj Fadnis ji, our honorable past president, CA Sudhir Soni, and CA Vijay Wadhwani. And we have taken a very good mix of the panelists from industry as well as the profession. As the topics are concerned, these changes have raised, a lot of interest. The changes have generated a lot of interest because the responsibility of the auditor as well as the auditee is going to significantly rise. Some of it was expected because CARO 2020 has a number of clauses due to which the Schedule 3 changes were imminent. But some of the changes are new. For example, keeping an audit trail of the accounting transactions in the software, and also certain provision relating to obtaining the management representation relating to money, advance or loan, etc. We'll take you through all these changes through this technical presentation as well as a panel discussion. We'll also be taking up the participants' question at the end. Now I would like to introduce our expert speaker who will be making a technical presentation, CA Deepa Agrawal. Deepa is a commerce graduate and an FCA with 13th rank in all over India and 5th rank in the northern region. She has almost 20 years of experience in serving national and multinational companies in the area of auditing and accounting, corporate laws, and other related matter. Currently, she is working as an associate partner in SR Watley & Co. LLP. She's an avid author and has written many publications on Companies Act and Trim financial reporting. And recently, her publication on a complete guide to the directors has also been released. She has completed the ISA course from ICAI in September 2006 and a certificate course on IFRS from ICAI in 2011. She has worked with the Technical Directorate of ICAI for around 5 years and has assisted and continue to assist ICAI in a number of publications in the area of corporate law and the Assurance and Auditing Standard Board, also on the accounting standards. She has been a special invitee on AASB of ICAI for 2 years and a special invitee on the Corporate Law Committee also for 2 years. She acts as a speaker in various seminars and webinars of ICAI on Accounting, Auditing and Companies Act. And she has imparted training to Chartered Accountant on Accounting Standard, India's Auditing Standard and other updates. Thank you very much, Deepa, for taking out time and joining us. And over to you. I would request you to keep your presentation to around 40 minutes, 5 minutes here and there. That's fine. Over to you, Deepa.
Thank you, Sanjeev. Thank you for the introduction and all you what said. Thank you to the Vice Chairman, sir, and everyone for organizing this initiative. So I welcome to all of you of this live webinar on navigating recent changes. I'll just quickly share my screen with you. Yeah. So a very good afternoon to all of you. And as Sanjeev mentioned about the various initiatives taken by the committee, I'm more than sure that this will go a long way. And I'm going to focus more on the important changes this afternoon about the recent changes in Schedule 3 to the companies, how it is going to impact the companies, how it is going to impact you as an auditor. The MCA issued the 3 notifications on 24th March 2021 and amending Schedule 3 to the Companies Act, Companies Account Rules 2014, and Companies Audit and Auditor Rules 2014. As most of you would have noted that these amendments are effective from 1st April 2021 as per the notification. However, the date for there was a discussion around the dates on the applicability of the auditor rules as well as amendment to Schedule 3. Based on the harmonious reading and the logical interpretations, the disclosures will be made by the companies for the financial statement for the year ending March 2022. The auditor report disclosure, the auditor report's reporting responsibility will also get triggered for the year ending March 2022, which means the audit report which our auditor will issue for the year ending March 22. While we expect MCA or ICAI to issue a clarification, but currently this is what the reading indicates on the applicability date. Moving on to the impact and the overview of the changes, which one should think about, and when you're looking at the changes. We should all note that the general instruction for preparation of the balance sheet, which is there in your Division 1, Division 2, and Division 3, which means for your Indian GAAP, Ind AS, and for NBFCs, the general instruction mentions that every company has to give the comparative information for all the items shown in the financial statement, including notes, except in the case of first financial statement laid before the company after incorporation. Therefore, the way this requirement is there in the Division 1, Division 2, and Division 3 of Schedule 3, it clearly indicates that the companies have to start thinking about the comparative information for the year ended March 22, which means right from today, when we are talking as in 1st April 2021, we need to think about the comparative information. At the same time, yes, there could be some challenges as we will navigate through the regulatory section and the additional disclosure which MCS notified especially for the regulatory portion to align with the requirements of CARO 2020. You will notice that the companies may face challenge for collating the comparative information, and therefore we may expect the MCA to issue a clarification or any kind of exemption in the due course. Moving on to the another impact which the companies should talk about and consider is assessing and making changes to the existing system, controls, and processes, because the disclosures have been significantly enhanced. And you will see some of the disclosures are more of the additional requirements. Some of the disclosures have been just straight away aligned with the requirements of CARO 2020. Some of the disclosure you may see that are repetitive in nature. So for example, for an NBFC, if there is a requirement to disclose some ratios under the RBI circular or the master directions, those disclosure of the ratios have been incorporated in the Division 3 of Schedule 3. So moving on to the next slide on the amendment to the Schedule 3, it talks about that depending upon the turnover of the companies, the figures appearing in the financial statement may be rounded off as given below. So the requirement of rounding off was mandatory for Ind AS company, whereas for Indian GAAP companies, it was not mandatory. The word was used maybe, whereas now it is shall be. So for the rounding off requirement, this is mandatory both for the Indian GAAP companies, Ind AS companies, and for the NBFCs. So they have aligned this requirement. And the nomenclature of total income has been changed to turnover. The turnover nomenclature has been changed to total income for both set of companies. In the balance sheet, again, there is a change in the nomenclature. The term tangible asset has been changed to property, plant, and equipment. And now the presentation, the companies, the Indian GAAP companies, the companies to which Indian GAAP is applicable, will use the nomenclature property, plant, and equipment. Moving on to another very important disclosure requirement, which is on the promoter shareholding. So currently, only the shareholding of the shareholders holding more than 5% of shares are required to be disclosed. Also, some of the listed companies under SEBI LODR regulation under Regulation 31 requires that all entities falling under promoter and promoter group are required to disclose separately the shareholding pattern appearing on the website of all stock exchange, having nationwide terminals wherever the specified securities are listed and in the format prescribed by the SEBI. So currently, these disclosures are required by the listed companies. Now, MCA has amended the schedule and the requirement. So the companies will have to disclose the shareholding, the promoter name, the number of shares, and the percentage of total shares held by the promoters. And also the percentage change has to be indicated during the year. Also, an important point to note here is the definition of promoter is as per the Companies Act. So there could be a difference in the definition in the Companies Act and SEBI LODR regulation. However, the definition which one has to follow while giving these disclosure requirement is as per the Companies Act 2013. The change has been made for all the companies covered under 3 divisions of Schedule 3, which means the change is applicable for all the companies which are applying Ind AS, Indian GAAP, or the NBFCs. Another minor change is on the short-term borrowing. So current maturities of long-term borrowing shall be disclosed separately. Earlier, this was required to be disclosed under other current liabilities. So this is more of a minor change made in Schedule 3. Another very important change, it talks about the trade payable, the aging schedule. So you will see that they have introduced aging schedule both for trade payable as well as trade receivable. So earlier, the companies were only required to disclose trade payables and the disclosure prescribed under Msme Act 2006 for the micro and small and medium enterprises. However, now what they have done is in the MCA has introduced this aging schedule, wherein they have mentioned that the disclosures have to be given for MSME, for others, and then they have given further subcategories talking about disputed dues to MSME and disputed dues to others. So the aging schedule has to be given less than 1 year, between 1 to 2 years, 2 to 3 years, and more than 3 years. So now the companies will have to start planning right from that this disclosure will be required to given in your financial statement for March 2022. The notes also mention that similar information has to be given where no due date of payment is specified. In that case, disclosure shall be from the date of transaction, and unbilled dues shall be disclosed separately. So this is completely a new requirement which has been introduced in Schedule 3. These are some of the minor changes wherein the current maturities of long-term debt has been now omitted from the other current liabilities, and is now required to be included under other short-term borrowings or borrowings as per the Ind AS. Similarly, for long-term loans and advances, security deposits have been omitted from long-term loans and advances, and now security deposits are required to be disclosed under other non-current assets and other financial assets under Ind AS companies. Another change in the tangible asset and now which is called as a property, plant and equipment in your division 1, which is applicable to the Indian GAAP companies. It talks about that a reconciliation has to be given of the gross and net carrying amount for each class of assets at the beginning and end of the reporting period. Now, what they have added here is that if change is 10% or more in the aggregate of net carrying value of each class of PPE, so the companies will have to disclose if the revaluation has been carried out and if the change is 10% or more in the aggregate of the net carrying value of the each class of PPE. Now, this change has been made to align with the requirements in CARO 2020. When you will look at the reporting requirements, you will see two kinds of reporting requirement which is required to be given by the auditor from next year onwards. One is this change that if the company has conducted a revaluation, then if the change is 10% or more, then the amounts have to be reported. So this requirement has been incorporated for all the companies. Similar disclosure has to be made for intangible assets as well. So if there is a revaluation carried out for intangible asset and if change is 10% or more, then the amounts have to be disclosed. Moving on to the next slide on the other non-current asset. So as I mentioned in one of the previous slides, they have added this security deposits here, which has to be given under other non-current assets. And the trade receivable aging schedule has been added at 2 places in Schedule 3, one under other non-current assets and second under trade receivables. So if we move on to the next slide on the aging schedule, they have incorporated the aging schedule about the trade receivable. Now the detailed aging schedule is required to be given for the both under Indian GAAP companies as well as your Ind AS companies. So the disclosures have to be given for undisputed trade receivables considered good, considered doubtful, and similarly disclosures are required to be given for disputed trade receivables. So if you look at now, they are the regulator requires the disclosures have to be made for the less than 6 months, 6 months to 1 year, 1 to 2 years, and more than 3 years. So the aging schedule has to be given in the required format given in the slide. Coming on to some other important disclosure requirement, now it is also required by the companies to disclose where the company has not used the borrowings from banks and financial institutions for the specific purpose for which it was taken. At the balance sheet date, the company shall disclose the details of where they have been used. So if you will recollect, there was a reporting requirement in CARO 2000, in CARO, it's there in CARO 2020, but it was there in earlier as well. So if the company has obtained fund and if they have not utilized for the purpose for which they have obtained, the auditor needs to report that fact. Now, if you look at this requirement, it has to be the company also needs to disclose the details wherever they have been used for any of the purpose other than the purpose for which such borrowings were obtained from banks and financial institutions. So this is a new insertion. And a minor amendment has been made in one of the existing disclosure, which talks about that if in the opinion of the board, any of the assets other than PPE and intangible assets. So they have added the word an intangible asset, a non-current investment. And if such any of the assets other than these three do not have a value and realization in the ordinary course of business, at least equal to the amount at which they stated, the fact that the board is of the opinion shall be stated. So now the intangible asset has been included in this list. Now I'm moving on to a very important section. As I mentioned in the beginning, you will see different kind of disclosures requirement. One, some of the minor changes have been made. Second, completely new disclosures have been introduced for better enhanced for transparency and better information to the stakeholders, for providing better information. And the third kind of disclosures are your additional regulatory information. So what this revised Schedule 3, how it's been structured, they have introduced a complete new section called as regulatory information, and they have put together all the disclosure which are required due to CARO 2020. So if an auditor is required to report on title deeds of immovable property not held in the name of the company, and the regulator is expecting auditors to talk about that, what kind of immovable property which are not held in the name of the company, whether it is held in the name of the promoter, whether it is held in the name of a director. Such disclosure have first to be given by the company now. So it talks about such disclosure shall be given for PP, investment property, PP retired from active use and held for disposal and others. A specific format has been given here within Schedule 3. And this is applicable for all the companies, which means for your Division 1, Division 2, and Division 3. The second one is on the revaluation. So as I mentioned in one of the earlier slides, the 10% threshold is there. So if the revaluation is 10% or more, that has to be reported. Here there is an additional requirement that the company also needs to disclose as to whether the revaluation is based on the valuation by a registered valuer as defined under Rule 2 of the company's registered valuers and valuation rules. Further, there is a continuing increased focus on the related party transactions. So loans or advances in the ledger of loans are granted to promoters, directors, KMP, and related parties that are repayable on demand or without specifying any terms of period of repayment have to be given specifically by the company. Again, to some extent, this is in alignment with the CARO requirements of 2020. Also, you may note that this is an existing requirement under AS 18 or in AS 24 under the applicable accounting standard, and in some cases it may tantamount to overlapping of disclosure. However, the intent of the regulator is very clear that there is an increased focus on the related party transaction, especially when we are talking about some of the advances given repayable on demand or without specifying any terms or period of repayment. In terms of aging schedule, as I mentioned about trade receivables and trade payable, they have also introduced the aging schedule for capital work in progress. So 2 schedules have been introduced for CWIP. The first one talks about that you have to give the details of the projects in progress, which are pending less than a year, less than 1 to 2 years, between 2 to 3 years, and more than 3 years, and projects temporarily suspended. So which means if the companies have suspended temporarily a project and it is with the company and lying in CWIP, the disclosures have to be given by such companies. The second schedule on the CWIP mentions about that whose completion is overdue or has exceeded its cost compared to its original plan. Then the details has to be given project-wise, again, break up into different aging cycle, less than a year, between 1 to 2 years, and 2 to 3 years. Similar kind of disclosure has also been required now for intangible assets under development. So for intangible assets under development, aging schedule has to be given on the lines of CWIP, projects in progress, projects temporarily suspended. And similarly, for the intangible assets whose completion is overdue or has exceeded its cost compared to its original plan. So the schedule and the aging analysis has to be given by such companies. Another important disclosure is to improve transparency for the stakeholders, as they will have to disclose any proceeding that has been initiated or pending against the company for holding any Benami property under the Benami Transaction Prohibition Act 1988. Specific disclosures are required to be given if a company is holding any Benami, if there are any proceedings which have been initiated or pending because the company is holding any Benami property. The details of such property has to be given, the amount thereof, the details of beneficiaries. If the property is not in the books, then the facts shall be stated, and where they are proceeding against the company under this law, as in better of the transaction or as the transfer, then the details has to be provided. Similar kind of requirements have been incorporated last year when the CARO was notified in CARO 2020. So the auditor is also required to provide a disclosure for the Benami transactions and if there are any proceedings or have been initiated against the company. Moving on to the next disclosure for the borrowings obtained by the company on the basis of security of current assets. So, the company is required to disclose whether quarterly returns or a statement of current assets filed by the company with banks or financial institutions are in agreement with the books of account. And if there is any discrepancy, then the company has to prepare reconciliation and also specify the reasons of material discrepancy. An important point to note for you is that it talks about quarterly returns for statement. So it has to be done on a quarter basis, which means effective June 2021, companies will be required to look at these quarterly returns or statement filed with the banks or financial institution, prepare such reconciliation. And similarly, the auditor will also be required to report in CARO 2020 as to whether at any point of time of the year, if the company has been sanctioned working capital limits in excess of 5 crore of rupees from banks or financial institution on the basis of security of current asset, then the auditor will also have to look at the quarterly returns or statement, look at whether it is in agreement with the underlying books of account, and if not, the reconciliation and discrepancies have to be reported in CARO as well. Moving on to the next requirement on the willful defaulter. So willful defaulter again was introduced in CARO last year, and now it talks about the company also has to make a disclosure that whether the company is declared as a willful defaulter by any bank or financial institution or the lender. Now, these words are very, very important to note that willful defaulter, what they are looking at can be by a bank or by a financial institution or other lender. The definition is there in the RBI circular, which talks about there is a circular that lender to cover all banks and financial institutions to which any amount is due, provided it is arising on account of any banking transaction, including off-balance sheet transactions such as guarantees, derivatives, and letter of credit. So the circular issued by the RBI talks about banks and financial institutions. It nowhere refers to the other lender. So probably we can expect more guidance from the regulators. However, the guidance note on CARO talks about that government or government authorities by virtue of power may be in a position to declare any borrower as a willful defaulter. So if the company has been declared as a willful defaulter, the disclosures will be required to be given here. Another disclosure talks about the relationship with the stock of companies. So again, with the aim to improve transparency and one of the additional disclosure, it talks about that the company has to specifically disclose the transactions under these categories if there is any relationship with or such transaction with the stock of companies under Section 248 and under Section 560 of the Companies Act 1956. So the company will have to give the disclosure for investment in securities, receivable, payable, and shares held by stock of companies. Moving on to the next slide on the continuing with the regulatory information. These are again some of the important disclosure which companies have to make. For example, where any charges or registration yet to be registered with the registrar of company beyond the statutory period, then the details and reasons has to be disclosed. Compliance with number of layers of companies. So if the company is not complied with respect to the number of layers prescribed under Section 2, subsection 87 of the Companies Act, then they will have to mention name as well as the CIN number of the companies beyond the specified layer and the relationship and extent of the holding of the company. So again, this is something the regulator is looking at, the company needs to kind of do a reaffirmation through a disclosure in the financial statement as to whether the company is compliant with the legal provisions. On the ratios, again, some of these ratios were already required to be disclosed under SEBI listing regulations, which means a listed company was already required to specify these ratios, some of these ratios as part of the financial statement. However, now MCA has added to that list, and they have made it mandatory for all the companies to make a disclosure for these ratios. So if I talk about the differential and additional ratios as compared to what was there in the existing listing regulation, that covers your debt service coverage ratio, return on equity ratio, trade receivable turnover ratio, trade payable turnover ratio, and your net capital turnover ratio, net profit ratio. So, and if you look at the intent here, they're talking about the explanation has to be given for any change of the ratio by more than 25% as compared to the preceding year. So think about now companies will have to talk about, give the explanation also as to why there is a change of each of these ratio if the change is more than 25%. Also, this will provide clear picture of the company's financial health and compliance to the stakeholder. So yes, it will be from the user's perspective, from the stakeholder's perspective, it will be easier for them to understand by looking at the ratios. Also, if you just correlate it with CARO requirements, so one of the requirement in CARO talks about that based on the financial ratios given by the company and looking at the other financial liability and asset position, the auditor has to report that no material uncertainty exists that a company is capable of meeting its liability as and when they fall due within 1 year from the date of the balance sheet. So again, this is part of your regulatory information. Another one is on the compliance with approved scheme of arrangement. So, or if you would remember that existing section 232 of the Companies Act require auditor to issue a certificate that wherever the scheme is being filed with the NCLT, the companies, they'll have to give a certificate that the scheme is in compliance with the applicable accounting standard. So now they have kind of brought out this requirement, which have to explicitly mentioned by the company in the financial statement that if there is any scheme which has been filed by the company, then that is in compliance with the accounting standards. And if there is any deviation, that has to be explained by the company. Now coming to a very important change, and here, I kind of add that similar kind of a reporting has been given for the auditor also through the auditor amendment rules. So where a company has advanced or loaned or invested funds, either through your borrowed funds or share premium or any other source or kind of fund, which means that it can be any kind of fund, not just restricted to your borrowings. It could be your share premium, it could be any other sources, to any other person or entity, including foreign entity, with the understanding that that intermediary will further pass on such funds to any other entity, which means the ultimate beneficiary, then specified disclosures have to be given. So MCA, by this amendment, is aiming to unveil the ultimate beneficiary behind this indirect financing or this camouflage financing. Such indirect funding needs to be adequately disclosed in the notes of accounts of the company. The amended audit rules also requires the management of the company to give a representation to the auditors that, except as otherwise included in the notes to account, which means itself acting as an intermediary for any financial transactions. Also, I would like, and 186 of Companies Act, which prohibits some indirect loans, investments. And therefore, this change is really very important. And the provisions are not just casting a responsibility on the directors, but on the auditors also. Similar kind of disclosures are also being incorporated in Schedule 3 for the funds received by the company. So if the company has received any fund from any person or entity, including foreign entity, with the understanding that the company shall directly or indirectly lend or invest in other persons or entities identified in any manner whatsoever by or on behalf of the funding party, which means the ultimate beneficiary, or provide any guarantee that the company will be required to disclose the funds received, the funds passed on to the ultimate beneficiary, along with details of such intermediaries or ultimate beneficiaries. If any guarantee or security have been given, then details of such guarantee or security. And another very important provision, which was even there on the previous slide, which talks about that the relevant provision of the Foreign Exchange Management Act and Companies Act has been complied with for such transaction, and the transactions are not violative of the Prevention of Money Laundering Act 2002. So this is again a very onerous responsibility cast on the management, and they will have to probably, think about the more compliances. And when we'll talk about the auditor amendment rules, the auditor's responsibility has been significantly enhanced. The auditor will have to look at all those funds received and given to the intermediaries, compliance with the requirements of the laws and regulations, and looking at whether such transactions are not violative of the Prevention of Money Laundering Act. Moving on to the next slide, which is some of the changes are very minor, which talks about that total revenue has been substituted by total income for Indian GAAP when we talk about the statement of profit and loss. Revenue from operation, they have added a new line item which talks about grants or donation received relevant only in case of Section 8 companies. This is only applicable for India's companies. And then another disclosure has been added for undisclosed income. So this insertion is also to align with the reporting requirements under CARO 2020. So this talks about undisclosed income needs to be given, which has been voluntarily surrendered or disclosed by the company during the year. So the emphasis is on the word surrendered or disclosed, which means that the company must have voluntarily admitted to the addition of such income, which can be demonstrated on the basis of returns filed by the company. And again, the auditor will also be required to report under on such disclosures made by the company. Coming to the CSR disclosure, so in beginning, we'll talk about the CSR amendment. So CSR amendments are notified with effect from 22nd January 2021. So earlier existing, if you look at the Schedule 3 requires that the companies which are covered under Section 135, the amount of expenditure incurred on corporate social responsibility activities have to be given. Whereas if you look at the current, the revised Schedule 3, the detailed disclosure has to be given, which means the amount required to be spent, whatever expenditure has been incurred, if there is any shortfall, and if there is any a total of previous year shortfall. It is important to note here that considering the provision have been mandated from current year, shortfall will be required to be reported from current year. So one has to be careful about these disclosure, the nature of CSR activities, and where a provision is made with respect to a liability incurred by entering into a contractual obligation, the movement in the provision during the year is also required to be shown separately. So these disclosure pertain to the CSR. Moving on to the one more important disclosure requirement on details of cryptocurrency or virtual currency. So these are again a new set of disclosure requirement. So companies have to confirm whether it has traded or invested in crypto or virtual currency during the financial year. And if the answer is an affirmative, companies must disclose profit or loss on such transaction along with the amount of currency held on the reporting date. And lastly, details of deposits or advances from any person for trading or investing in these currencies must be separately mentioned. Now, we just discuss and try and understand the intent behind the rationale for addition of these clauses. Probably regulators felt that if the companies are involved in trading or of cryptocurrencies, then there has to be a transparency about the magnitude and how much money is being made through such trading activity. And therefore, it is important for stakeholders and investors to understand while looking at the financial statement. So investors now can look at the financial statement if companies have invested in cryptocurrencies. The amendment is expected to bring in a lot of transparency in reporting or filing of crypto investment. The government's intent seems to include and regulate cryptocurrencies. So this is a completely new insertion. Moving on to the next slide, which is on Division 2. So this slide only talks about some of the additional changes which have been specifically made to Division 2, which is applicable to India's companies. An additional line item has been added for disclosure under non-current liability, which is your lease liability. For current liability, again, similar line item has been added. In the other financial asset, they have added a line item on bank deposits with more than 12 months maturity. And other non-financial asset is a new insertion under which they have even required companies to disclose security deposits. This is again on Division 2, which is applicable for the India's companies. So they have added the fair valuation if the company will have to disclose whether the fair value of investment property is based on the valuation by a registered valuer. So for investment property and for intangible asset, they have added these two additional disclosures specifically for the India's companies. and which probably would have to be considered by the auditor as well while reporting under CARO 2020. Moving on to the next slide on statement of changes in equity. So prior to the amendment, the companies, including NBFCs, were required to prepare a financial statement as per Ind AS. They were required to only disclose the balance at the beginning and end of the reporting period. So if you look at here, the balance at the beginning and end of the reporting period and changes were to be disclosed. However, now post the amendment in Schedule 3, disclosure shall be made regarding the changes in equity due to prior period errors and restated balance at the beginning of the reporting year, and similarly disclose the same for the previous reporting period. So all these circles which are there on the slide, these are new additions which have been made now on the statement of changes in equity. So this is applicable both for the Ind AS company as well as for the NBFCs. Another important change which they have mentioned is that for remeasurement of defined benefit plan and fair value changes, they have mentioned that they have given you an additional option for disclosure that it can be even given as a separate column under reserves and surplus. So this is a change which they have mentioned, change in the statement of changes in equity, both for the Ind AS companies and NBFCs. Coming to Division 3, one additional change which is not there and which is specifically made for NBFCs. So the additional ratios has to be disclosed, like your CRAR, Tier 1 CRAR, and your liquidity coverage ratio. And as I mentioned in beginning, in some of the cases, you may note that this is kind of a repetition. So as per RBI circular, NBFCs having deposit-taking NBFCs and non-deposit-taking NBFCs having asset size of rupees 500 crores or more are required to disclose your capital to risk-weighted asset ratio. And in some cases, they are also required to disclose liquidity coverage ratio. So some of the disclosure may seem to be repetitive, but now these are part of Schedule 3, Division 3. So this was all on Schedule 3, and I'm now going to quickly cover on the amendment to the Companies Accounts Rules 2014. In addition to changes in Schedule 3, what we discussed so far, MCA has also amended Companies Accounts Rule 2014 and added a provision in Rule 3. Rule 3 talks about manner of books of accounts to be kept in electronic mode, which requires that the books of account and other relevant books and papers maintained in electronic mode shall remain accessible to in India so as to be usable for subsequent reference. So a provision has been added to this sub-rule 3, which talks about that provided that for the financial year commencing on or after 1st April 2021, which is start effective from today, every company, so this is applicable to all the companies, no threshold, no exemptions. So every company which is using accounting software for maintaining its books of account shall use only such accounting software which has a feature of recording audit trail of each and every transaction, creating an added log of each change made in the books of account, along with the date when such change were made, and ensuring that the audit trail cannot be disabled. So this is a provision they have added. So now the compulsory maintenance of audit trail is a way to ensure that there will be no fabrication of books and any subsequent overwriting in the books of account. So through the audit trail, and which they are making mandatory, any person who will scrutinize the books of account can very easily track what changes have been made to the accounts and can require the company to explain the reasons thereof. So again, there's a very significant change, and the companies will have to, probably large companies may not face such issue, but then the smaller set of companies will have to look around that probably if they are using an accounting software, then whether they have, such software has a feature of recording audit trail. Another disclosure besides this, another amendment which has been made in the Companies Accounts Rule, they have added additional disclosure in the board's report, which is applicable again to all the companies. So through this amendment, the directors will now be required to report the applications initiated or proceedings pending against the Insolvency and Bankruptcy Code 2016 during the year, along with their status as at the end of the financial year. So they will have to make this factual disclosure if there is any proceedings pending and what is the status at the end of the financial year. And the aforesaid amendment may be said to be an additional reporting requirement to keep the members as well as the stakeholders updated about the current status of the company. The insolvency is definitely a serious matter, and the stakeholders, the shareholders should be very much aware about if the same is when the same is announced publicly at a later point of time. Another very interesting insertion in the board's report is the details, including the reasons of the difference between the amount of valuations of the company done at the time of one-time settlement and the valuations done while taking loans from the banks or financial institution along with the reasons thereof. Now, this is with a motive to understand if there is a difference in valuation of the assets of the company at the time of one-time settlement versus at the time of borrowing fund from the banks or financial institution. So the change will ensure that the company has not inflated the value of their books at the time of seeking loans from banks or financial institution, nor has it deflated the same at the time of proposing one-time settlement. So this is an important change for companies and auditors. So this will lead to more accountability of company personnel, will increase in transparency, and the company, as I mentioned at the beginning, should get up their accounting software that has the feature to record audit trail to each and every transaction throughout the year. Moving on to the next slide, which is on the audit and auditors amendment rules. So we spoke about Schedule 3, we spoke about the amendment to the accounts rule. These amendments were also made in the audit and auditors rules, and you will see some of these are connected to what we have discussed in the regulatory information in Schedule 3. So here, the auditor will be required to report effective from 1st day of 2021 that whether the management has represented that to the best of its knowledge and belief, whatever they have disclosed in the notes of account, there's nothing other than these, the disclosure made in the notes to account. Which means the disclosure which we have just seen in that slide for the ultimate beneficiaries, for the guarantees given by the company on behalf of beneficiaries, and similarly for the funds received by the company, whether there is any material misstatement, whether some disclosures have not been given, the auditor will have to give such kind of a reporting here under the regulatory reporting requirement section. So the purpose of this additional reporting, as all of you can see, is to identify the camouflaged lending or investment, that is, wherever any loans, advances, and investment are intended to be routed through an intermediary or any pass-through entity, masking the identity of the ultimate beneficiary. So the provisions are not just casting a responsibility on the directors through amendment in Schedule 3, but the auditors are also required to substantiate the statement of the directors by applying their audit procedures. So if you look at the third point, it talks about based on such audit procedures that the auditor has considered reasonable and appropriate in the circumstances, nothing has come to their notice that has caused them to believe that the representation contained any material misstatement. So this is something, this will require additional audit procedures, efforts from the side of auditors, and we expect that probably the ICAI may issue some guidance for its members. So definitely the amendments can be looked upon as a way to ensure that the companies do not use cover-ups for the purpose of distinguishing the identity of the ultimate beneficiary of the fund. These might also be to check the instances of money laundering. The changes will require the auditor to obtain representation from the management and perform additional procedure to ascertain that funds are not lent to intermediaries for the benefit of the other parties. Such transaction may sometimes be done to circumvent regulations on related party transactions, and therefore the objective of the regulator is to identify such instances wherever the funds have been diverted. Moving on to the next slide on one of the last amendment made in the audit and auditors amendment rule is about the declaration of dividend. So the amended audit rules require the auditor to report on compliance with Section 123 of the Companies Act 2013. As to wherever it has declared or paid dividend. So this has been done to ensure that the companies pay dividend on the basis of the profits and satisfy all the necessary conditions, and not where the company may be suffering losses and it is not practically possible. So again, the auditor will have to give an additional comfort probably here also to the regulator that the company has complied with the requirement in terms of computation of the net profits, in computation of compliance with the dividend rules. They have complied with all the requirements of Section 123 of the Companies Act. The auditor will also have to report about whether the company has used the accounting software for maintaining its books of account, which has a feature of recording audit trail. So as I just mentioned about the amendment in Companies Accounts Rule, so this is a reporting requirement cast upon the auditor. So it talks about that the audit trail has to be, the auditor will have to mention about whether there is a feature and there is a edit log facility, and the same has been operated throughout the year for all transactions recorded in the software. So these words are very important to note that the auditor has to report whether the audit trail, that feature is been operating throughout the year for all transactions, and the audit trail feature has not been tampered with. So this is really a onerous requirement, and probably the additional procedures will be required to be carried out. And the auditor will also have to talk about that the audit trail have been preserved by the company as per the statutory requirements for record retention. Now, considering these amendments are effective from April 2021, so probably since this is effective prospectively, the auditor will be required to talk about this feature effective from April 21. Otherwise, if one talk about the record retention period, Section 128 requires companies to maintain the records for a minimum period of 8 years. So the reporting change will not only increase the IT testing of the accounting software for the auditors, it will also enhance accountability among company personnel and enable audit of pervasive control, for example, segregation of duties using technologies. Companies will immediately have to gear up their accounting software to enable audit trails, logs of transaction, which should not be disabled or tampered with. Most large companies that work on ERP system do have controls whereby they can make sure that an audit trail of accounting entries and a log is available. The challenge may be on the smaller entities and the smaller businesses that may be using software without such features enabled or available. Again, the auditor will also be required to use technology skills to make sure that the company follow these guidelines. So coming towards end of the technical presentation, so through though certain disclosure may lead to repetition of information, some of the disclosure have been made to align with the requirements of CARO. Again, the auditor as well as the companies may see wherever there's a repetition, whether a cross-referencing is required, and let's wait for the regulators to issue more clarification or guidance. So, so this is from my side. So thank you, but happy to take any questions if any. And with this, I'll hand over back to Sanjeev Singhal.
Thank you very much, Deepa. This was indeed a very, very useful presentation. Many of our members have asked for a copy of the presentation. We'll be hosting a copy along with the link of the program. And I'm happy to inform that 3,884 members are watching, and there are 9,536 hits for the program. So that speaks voluminous about the importance of the subject. And now it's indeed a pleasure to introduce the three eminent panelists. And our panel today comprises of our regulator cum practitioner, our Honorable Past President Manoj Fadnisji, a person from industry, Vijay Wadhwaniji. Probably he's addressing in an ICAI committee on a public platform for the first time, and then an auditor, a very experienced auditor, Sudhir Soni. So let me start with the speaker from industry who is among us for the first time in a webinar, Vijay Wadhwani. Vijay is the General Manager, Finance and Account from Minda Industries. He's also the indirect tax head of the group. He deals with finance, accounting, auditing, merger, acquisition, transactions. He's also a co-opted member of the research committee of the ICAI this year, and has worked extensively in the legal and secretarial. He has established the whistleblower mechanism across the group, which resulted in improving the confidence level of employees and the other stakeholders. He has established effective and efficient mechanism to track all legal compliances across the group, resulting in proactive monitoring at the corporate level and reduction in the number of non-compliances. He has led the secretarial practice of the group as well, and has a fairly rich experience of working on the profession side as well. Thank you, Vijay, for joining us today. And then it's indeed a pleasure to introduce Sudhir Soni. Sudhir is a fellow member of ICAI with more than 30 years of experience. He's a partner in the assurance practice of SR Bartleby and was the national assurance leader until last year. He also serves as the audit engagement partner for several listed Indian and multinational companies. He's a member of the CII National Committee on Financial Reporting and CII National Committee on Corporate Governance. He has served the Institute on various prestigious committees, including the Accounting Standard Board and the Ind AS Implementation Committee. For many years, he's been a Shield Panel member for Excellence in Financial Reporting Awards of the ICAI. Thank you, Sudhir, for joining us today. And then I have the pleasure of introducing our Honorable Past President, C. Manoj Fadnisji. Manoj Fadnisji is the immediate president of the Confederation of Asian and Pacific Accountant, CAPA, a regional international organization of 32 professional institutions from 23 countries from Asia and Pacific region. He was elected as the president of ICAI for 2015-16 and has served as the vice president for 2014-15. As president, he was the chairman of all the standing committee, disciplinary committee, and the board of discipline of the ICAI. He was also the non-executive director of the IRDA, member of the National Direct Tax Advisory Committee of the Central Board of Advisory Committee. And during this year, he's a member of the International Affairs Committee of ICAI. On 8 November 2017, Manoj Fadnis was elected as the president of CAPA. He has been elected as the president for a term of 2 years from November 17 to November 19. He's been a board member since February 15. He was elected as a deputy president from November 15 to November 17. He also served as a chairman of the Public Sector Financial Management Committee of CAPA from November 15 to November 17. He was also nominated as a member of the Small and Medium Practitioner Committee of the IFAC for 2016 to 2018. He's also been nominated on B20 for the year 2018. B20 is a business group formed by G20 based in Buenos Aires, Argentina. Presently, he is an independent director on the board of Federal Bank and serves as chairman of the audit committee. He's also on the board of various listed and non-listed companies. His achievements are many, and in fact, he serves the profession to the fullest of his ability. I have seen him taking 3.5 hour session in the Ind AS implementation course with so much of passion. Probably he has taken session in almost all the 19 batches which we had done in the last year as a part of the accounting standard board when Ind AS certification course was a part of the ASB. Thank you so much, sir. Thank you so much for joining. And now I would like to start. We have received more than 80 questions and questions are pouring in. We'll try to combine as many questions as possible. And the way we are structuring it, that probably I'll take up some questions to Manoj Fadnis and Sudhir Soni, and Prasannaji will take up some questions to Vijay. So probably one question I will ask from Manoj Fadnis, Sudhir Soni, and then one question to Vijay Wadhwani, and in this direction we will do. And while answering the first question, request to all the three panelists, if you have any opening remarks, please feel free to share. So first question is to you, Manoj Fadnis, sir. There are primarily three changes in the company's auditor report order, in addition to, of course, what is there in CARO 2020. The first one relates to funds advanced or loaned or invested by the company with an understanding that the intermediary, whether directly or indirectly, lend or invest in the other person, etc. Some are viewing it as it's a report on the management representation. And then an auditor is, of course, required to go beyond management representation. What do you think, sir? What's your advice to an auditor? How should an auditor discharge his obligation in respect of the above? Over to you, sir.
Thank you, Sanjeevji, and my compliments to you and to your entire committee, co-chairman and others for organizing this program at a very timely point of time, in the sense that, and as you mentioned, nearly 4,000 viewers are watching this program. So it really goes to show the importance of this program as of today. A very excellent presentation made by C.A. Deepa Agrawal, and which very lucidly explained the amendments in Schedule 3, and I'm sure that would have satisfied many of the queries which people would be raising. It would be useful that it is clarified either by the Institute or by the Ministry of Corporate Affairs that the auditors' amendment rules are effective for the financial year starting from 1st of April 2021, because there are people who are having apprehensions that it is applicable for audit reports signed on or after 1st of April 2021. Having said that, I believe that these are, as is widely also believed, that these are applicable for the year 21-22, and therefore these are the audit reporting requirements which should be applicable a year from today. Having said that, suitable clarification from the government or from the institute would be very helpful to the members at large. Coming to this specific issue with respect to, which is essentially arising from money laundering transactions which have taken place, and with an object to prevent that, the reporting requirement has been brought in under Schedule 3, as well as a reporting requirement by the statutory auditors. Now, the auditors would, of course, be relying on the management representations, because here it says whether there is an understanding, whether in writing or otherwise. Now, if it is in writing, it can be verified by the auditors. If there is an understanding which is not even reduced to writing, it is just impossible for the auditors to fish it out and to report it in any way. And therefore, the auditors to a large extent would be relying on what is there, which is documented, and which is otherwise will have to be relied upon by way of the management representations, which the auditors would be taking. Now, in coming to the type of amendment which has come in, it is important that one should look at the related party transactions more carefully. That is, the kind of disclosures which have gone up with respect to related party transactions indicate that the government's intention is to closely scrutinize the related party transactions. So where you have a funding party and an intermediary and, as has been said, an ultimate beneficiary, if the intermediary is a related party or there are ultimate beneficiaries who are related parties to the company where the auditor is auditing, one will have to be more careful in just relying on the management representations, and suitable disclosures would be required. As was also referred to, there are provisions contained in section 185 and 186, where there is also a reporting requirement under CARO. Even under CARO 2016, we are reporting with respect to the compliances under 185 and 186. So these all will have to be carefully looked into by the statutory auditors when responding not just to the requirements under CARO, but also with respect to what is envisaged in terms of the new rules brought in. I must also add that under section 143 subsection 1, the auditors have wide powers to access the books of accounts, vouchers, and other documents and records of the auditing company. And by way of the proviso, the similar powers have been extended to the auditors for the subsidiaries and associates. Now, that is in a way limited to the purpose of consolidated preparation and audit of the consolidated financial statements. But using those powers, it is not that the auditors do not have the statutory powers. So I think as auditors, we need to be reminded of what powers have been given to us under the statute and under the auditing standards, which are also notified as part of the Companies Act. And I think looking at these provisions, one should discharge one's obligations under the new reporting requirements.
Thank you very much, sir. Moving on to you, being an auditor, I mean, what will be your advice to the auditor for discharging this particular obligation, which Manoj Fadniji referred? Do you have any other insight, any practical advice to the auditor? And also, what's your view on the applicability of requirements on Schedule 3 and on the company's auditor report order of these amended provisions?
Yeah, thanks, Sanjeev. And I'll just echo the compliments that Manoj has made to you and the committee on organizing this program very timely. Coming to the overall direction, I think, of the changes that have taken place since CARO, the amendments to Schedule 3, and also the amendments to the auditor's report, I feel that the regulators are placing increasing emphasis on fraud, on going concern, and on matters relating to compliance with laws and regulations. I think historically these have been topics which we have attributed as expectation gaps between what society expects from an auditor and what auditors perform. And I think these changes to some extent are trying to bridge that. Coming to this specific question on this additional reporting requirement, I believe that the requirement that has been placed, the two requirements first are on obtaining representations relating to loans given and obtaining representations relating to loans taken. But if you see the wording of what is expected from the auditors, it is said that such procedures that are considered reasonable and appropriate. And I think that is a very wide terminology, and it will place an auditor on inquiry. I feel that the auditor will have to inquire about the business rationale of loans that have been given to very well understand what is the objective of loans that have been given or taken. You may also decide to obtain selectively representations, and I'm not sure whether the right word is representation, but or a confirmation from the borrower or the investee company to see where they have deployed the funds, because you will not have access to their books. So I feel that you will need to go beyond your books of account, because clearly what the regulator is trying to seek is the end use which has been done by the borrower or the investee company, and you may need to obtain representations from them selectively on a sample basis. You may need to understand how the company is monitoring the end use of funds which have been borrowed or invested. And sometimes you may even ask a company to obtain financial statements of the borrower or investee to validate where that fund has actually been deployed. And today, with the way data is available and officially and legally available from either MCA sites or public information, I don't think an auditor should be constrained by only relying on representations or the books of accounts. And you may have to step beyond that to see publicly available data to see that you don't have any contradiction to the representations that are being made. And finally, I just have one more comment here, and Deepa already mentioned this in her presentation. But what is not said in the auditor's report is a specific point regarding the Prevention of Money Laundering Act and the FEMA compliance. Now, whereas that may not have been specifically mentioned in the auditor's report, remember that this is a disclosure that the company is being asked to make in its financial statements, and your auditor's report covers the financial statements. And to that extent, I think we will, of course, hope that Institute will come out with more guidance. But I believe that when the auditor confirms that financial statements are not misstated, then even if a company has made a representation that there is compliance with FEMA in the Prevention of Money Laundering Act, I believe the auditor will also be put on inquiry to say, is that representation acceptable? And if necessary, you may need to support with legal opinions in case there are doubts in that matter. So I think it's a far-reaching requirement, and you'll have to have fairly extensive procedures to audit this.
Right. Thank you, Sudhir. In fact, Institute will certainly come out with a guidance. And my personal view also is that this is applicable from financial year 21-22. And I've been told that MCA is coming out with a clarification on the same. Thank you so much. Over to you, Co-Chairman Prasanna, for the next question to Vijay.
Yeah. Now the query is to Mr. Vijay Wadhwani. So do you feel there will be any practical difficulty that the industry will face due to compulsory maintenance to audit trail? So you have to unmute and speak, sir.
Yeah, sir. Good evening, everyone. And thanks, Prasanna ji, Sanjeev ji, for considering me for this opportunity and sharing dice with eminent personalities. And of course, coming back to the views shared by Manoj ji and Sudhir ji are very well taken. And of course, this will be applicable from April 2021, everyone hopes. And this time we are thankful to the government that they have not come up with the notification couple of days earlier. And it is the 1 year, which they have given to us for making all these compliances and this reporting requirement. So coming back to your question regarding audit trail maintenance. So I believe for companies, for big entities, I don't see it is a challenge. It is an issue because already they are maintaining their accounting in the accounting software like ERPs, SAP, Oracle, or other ERPs. So in those ERPs already there is a functionality to maintain all the audit trail of all the transaction which has happened and recorded in those software. The concern would be in the small entities who are using like software tally. Like even in our groups, like for 40 entities we are maintaining. Out of 40 entities, there might be 4 or 5 entities where accounts we are maintaining in SAP, in Tally, not in SAP. So there it will be an issue. And of course, the deadline for this audit trail compliance is from 1st April 2021, which is today. And till now, we haven't received any feedback from Tally or other small software entities, whether they have given this functionality or not, and what are the timelines which they are looking for. But per se, for big entities, I don't see this is a challenge. Rather, this is a good step. So that no modification or no modification can be done with a malevolent intention. Of course, modification is done in accounting, but not with a malevolent intention. So you cannot delete anything, you cannot do anything where trail is not available. And this is good for auditor also. Because while they do audit, they do IT testing also, and they also confirm whether this audit trail is available or not, and where are the manual intervention in your software. So per se, this is a good step to bring more transparency, and it will give more comfort to the management and the board level also. Yeah. Ultimately, board is board is taking comfort on our comfort. So right, that is good comfort for the board also.
Right. I think that is very well articulated, Vijay. And I would also like to clarify the esteemed audience that, it is not that a mistake cannot happen. They can be corrected by passing a reversal, or they can be corrected by passing a JV. What is not permitted is a deletion of an entry, which, some of the software has that facility. So you can always amend. There are people who are saying that, if we do the accounts, if our accountant is passing the entry on a monthly basis, which can happen in smaller companies, so whether that will create a problem, that is not likely to create a problem. No one is saying why you are passing the entries on a particular date or at the end of the month. What is being asked for is a maintenance of an audit trail. Let me ask the auditor perspective on this very, very important change. So this requirement we have heard, what implication it will have on the scope of the work of the auditor, how extensive is the change, and what type of change an auditor will need to make in his ICFR testing. And in case, let me ask you one more sub-part, in case the audit trail is not maintained, whether it will have an impact on the other audit procedure carried out by the auditor. Over to you, Sudhir.
Yeah, I think I'll again endorse what Vijay said, that this is clearly a step for better controls and so that a proper trail is maintained. Already in the large ERPs, this feature is available, and auditors, as part of their IT general control testing, are already doing this. So when we look at these ERPs for testing, we look at whether the logs have been enabled, whether a trail is available, and if that is not there, you would decide whether the IT general control is effective or not, and how reliable it is or not. And therefore, in my view, this is already a part of an auditor's evaluation of an IT system. What, of course, has now happened is that good control has become a regulation. And I think increasingly we are seeing a direction of what is good practice is getting regulated, going to on a different tangent. For example, CSR is being regulated. Similarly, in this case, having a good IT system which maintains these trails is becoming a subject of regulation. And the fact is that now auditor has to make a specific assertion. The difference is that in the past, we looked for this. If it was not there, you'd work out audit procedures to address the risk of deletion and things of that sort. Now you are being asked to make a specific assertion that these have been maintained and the records have been retained. And therefore, the auditors will need to, one is upgrade their technology skills to be able to identify that all these have been maintained. And it's quite onerous because it says that this has to be maintained throughout the year. And so I think auditors' testing will be extended to see that at different points. Obviously, all audit work is done on a sample basis, but you will need to pull out samples from throughout the course of the year to determine that whether these logs and trails are available, and certainly use technology skills to perform those procedures.
Right. Thank you, Sudhir. Manoj Fadne, sir, your view on this particular change, and also there are two more aspects I would like to ask, which have been asked by our members, Vishal Jain and ACC Malati. So apart from the question on that, what is the likely change on the ICFR testing, and also if audit trail is not maintained, is the auditor going to carry out additional procedure or qualify his report? Is also an additional aspect that's being asked is that, like Vijay mentioned, they have 40 companies in their group. So of course, I am of the view that all companies can maintain their accounts on the same software, but still, for the sake of clarity, a member has asked that, is it possible that a company can use a single accounting software, or they'll have to use multiple accounting software. In my view, multiple accounting software are not required, but I would like to hear from you. And also an additional aspect, that whether any disclosure is required to be given with respect to the software used by the company, that is, which software are you using? Your view, sir.
Thank you, Sanjeevji. This is something which, as mentioned by the two other esteemed panelists, that it is what is already there in terms of companies which have migrated earlier to ERPs and using different types of ERPs. So this is a control which is in place insofar as the larger entities are concerned. And in carrying out the audits of those entities, the auditors are also familiar with the kind of testing which is required to be done under those environments. Having said that, this rule which has come in on 24th of March and which is requiring all companies to migrate to this specific requirement with effect from 1st of April 2021 is quite challenging, to say the least. And therefore, the large number of companies, and more particularly the smaller companies, which have using various kinds of local-made softwares, will find it challenging, not just in terms of the time that it would take to migrate to these kinds of softwares, because it requires a dedicated team and resources. It requires a substantial amount of investment to be made so that the necessary systems are in place. And therefore, many of the companies will not be having these kinds of facilities starting from 1st of April 2021. Assuming for our sake of discussion that there is no change in the reporting requirement, so it would be very important that the guidance which all of us look to from the Institute should bring out very clearly that where the systems are not in place as on 1st of April 2021, but are implemented during the year, what kind of audit procedures are required and what kind of reporting is required. And many companies may not be able to implement this even till the end of the year. And therefore, those companies, in relation to those companies, what is the kind of reporting which would be required from the auditors? So these are larger issues which I'm sure Sanjeevji, you and Prasannaji and the other council members are already seized of, and suitable guidance would come forth from the Institute on these very important matters. Now, assuming there is no audit trail, and that is the case with majority of the smaller entities, where there is a accounting software, where there is a good controls and systems in place, but the software does not have that kind of an audit trail. Now, when the audit is carried out under such an environment, even today, the auditor is required to perform several additional audit procedures to satisfy oneself that in the absence of that audit trail, nothing has been changed, deleted, edited, modified during the course of the audit, because the audit does not really start at the end of the year. The audit would have started well during the beginning of the year or throughout the year. And at that point of time, it is important to bear in mind that what audit has already been completed, to that extent, those informations are not deleted or edited or modified. So there are certain audit procedures which are already in place, and the auditors would be implementing such audit procedures which need to be carried out where such kind of systems, good controls and systems are not in place. Now coming to ICFR, where this would also become a part of separate testing, because as mentioned by Sudhirji, that now these are good controls which are becoming part of the regulatory requirements. And when it becomes a part of regulatory requirements, then the importance which is required to be given to testing that control has to be more than what is a normal audit procedure. And therefore, I believe the auditors will have to do a little more extensive checking where such controls are not in place. Because now that the audit trail is not available, and the audit trail is not available is being reported as a non-compliance, there it would be important that what are the audit procedures which are being carried out to ensure the correctness of the financial statements, that there is no material misstatements in the financial statements because certain information has been deleted and that deletion is not being traced in the software which is being used. So I think that all these increase to a certain extent the work which is to be carried out by the auditors, the reporting which is required to be done, and the guidance from the institute will certainly be very helpful and useful to the members.
Yeah, Sanjeev, if I may just come in there.
Yeah, please.
Yeah, on the your very specific question on ICFR. So if the question is that if audit trail is not maintained, then theoretically, should there be a immediate decision to qualify the internal controls or financial reporting? I don't think theoretically that will be correct, because as Manoj rightly said, even today you are reporting on ICFR in this situation. And therefore, you are identifying probably mitigating controls to the risks that arise because of the fact that the software does not provide a trail or a log. So I don't think it should be an automatic conclusion that ICFR is qualified if this trail is not maintained. That is one point. And second is, I'll just repeat that there is a distinction between the ICFR requirements and what this particular requirement is on the timing. We all know that ICFR is reporting as of the end of the year. And so, for example, if you have found a deficiency during the year, but it is rectified by the year end, you still get a clean report to say, as of 31st March of a year, the controls were working fine. Whereas in this case, there is a very specific requirement which says throughout the year. So I think this is a slightly different requirement, and it need not necessarily link into a ICFR conclusion.
Right, Sudhir. Thanks for that clarification. Manoj Fadnis, sir, I mean, emanating from this only, because this is a very, very important aspect. If you are in a disciplinary bench and, you know, there is a qualification or if you're in a regulatory position, sir, if there is a qualification by the auditor on this aspect that the accounting software did not have an audit trail, are there likely to be follow-up questions that you know, how did the auditor satisfy about the integrity of the accounts? How he satisfied himself that the entries have not been deleted? Do you see as a consequence thereof any other implication on the auditor work?
I would not believe that merely because there is no audit trail available should lead to any kind of additional investigations on the part of the regulators, because all these years it was well accepted that there are accounting softwares which do not have this kind of a audit trail. Now, in terms of evolution of the software which is required in terms of ensuring good corporate governance, it is now being mandated that the accounting software should also have such inbuilt controls so that there is a proper audit trail available. Therefore, in case of unfortunate proceedings under the disciplinary proceedings of an institute or the other regulatory body, this should not immediately would result in a kind of a kind of a belief that the auditor has made a mistake or the auditor has not carried out his duties with due diligence, because this is a fact which is there all these years, and it is now that something more is being required to be brought in. By the time the companies actually go and bring out all these systems in place, the auditors would be well justified in reporting that such audit trails were not available either throughout the year or that they were not in existence even right till the end of the year, as the case may be. And we'll find that many companies, and particularly the smaller companies, the non-compliance in this regard could be very high, assuming that there is no change in the timelines which have been promulgated. Therefore, I would believe that the auditor should carry out his audit procedures as properly as is still being carried out, but at the same time document them effectively so as to bring out to the investigating agencies and the regulatory agencies the kind of audit work which the auditor has carried out.
Thank you very much, sir. And I can tell you that now more than 10,000 hits are there. So more than 4,200 people are watching it live. Thank you very much. I would request Prasanna ji to take up the next question with Vijay.
Yeah, this is called to Vijay. Say Vijay. So there's a requirement to give certain set of ratios. You know, even for the ratios, there are different sets of formulas available. Do you think some kind of formula to be given by MCA or ICAI to maintain standardization for computing the ratios? Sir, please unmute and speak, sir. Sir, please unmute. Vijayji.
Yeah.
Right. Now all right.
Yeah, so giving the ratios in the financial statement is a very good step. Where ultimately all your investors, stakeholders, financiers look for the ratios. So giving ratio is again a very good step which MC has taken. But of course, the standardization of ratio, like all the parameters of ratios, what should be the component in inventory, what should be the component in your debt, what should be component in your debtors and creditors, that should be standardized by MCA. So because if you want to do benchmarking among the companies within the same industry, then you need the standardization of those ratios. Then only it will be fruitful. Otherwise, everyone will use its own method of computing these ratios. Even today, I mean, within the organization, outside the organization, everyone sees the financial from the ratio perspective. Even the auditor, when they start the audit, they first see the ratios. Okay, what are the ratios? So, of course, so MCA should give some standard method or standard computation that what should be the component of all these items. And I believe even if MCA doesn't provide such kind of standardization, so our institute definitely will provide in the guidance note.
Absolutely, Vijay. If MCA doesn't provide, and MCA is not likely to provide, but yes, in our guidance note, we will certainly provide that. And of course, for computing one ratio, there could be two different alternatives as well. So as long as the basis is disclosed, I think that should be fine.
Right.
So the number of questions on audit trail are pouring in. So I'm constrained to ask one more question to Manoj Fadnis, sir, and probably Sudhir or Vijay, if you want to supplement, you can add. There is Sunil Agarwal ji is asking a question. Sunil ji is from GSA. In case of audit trail log for backdated vouchers or modification, if the IT head of the auditing company gives an undertaking that the backdated vouchers or deletion or modification is disabled from the system, therefore no audit log or trail is generated from the system, will it be sufficient for the auditor, for the purpose of not giving a qualification, or how should an auditor react to this?
No, well, as I understood this question from a very esteemed colleague of ours, an esteemed member, Sunil ji, that the IT head is giving undertaking that the audit trails are deleted. Is that what I heard you correctly? So if they are being deleted, it does not meet the requirements of what is there in the new rules, because those audit trails will be required to be maintained for a period which is statutorily prescribed under the Act. And therefore, such a undertaking given by the IT head would indicate a software which does not meet the requirements of a software which is prescribed under the rules. And therefore, it would, in my humble view, it will not be acceptable as an auditor.
Right, sir. Thank you. Sudhir, do you have any view on this? And there is one more question that has come in. For how many years the audit trail should be maintained by the company? If you can answer both these questions.
Yeah, okay, I'll take the second one first. I think Deepa in her presentation mentioned that the requirement is 8 years. And this will be, I would also interpret like she did, that this will be prospective, which is because it's now that this requirement is coming in. So from 21-22 onwards, you have to start keeping it, and the auditor must see that it is available for then and 8 years thereon kind of a situation. But your question, I thought, was that can you rely on the IT head's representation from a compliance perspective? I think where Manoj said is where he says they have not complied. But I'm also saying even if the IT head were to certify compliance, I think the question is that good enough? And my answer to that will be no. I think an auditor is expected to verify even representations which are made. And therefore, you will be obligated to do some sort of testing yourself to ensure that the representation is acceptable, that there has been compliance, that there has been no tampering of the audit trails during the course of the year. And therefore, I do believe that as auditors, we will need to up our technology skills a bit and build some procedures to verify such a representation. So in all matters of financial statement, we do take representations, but to some extent, you have to verify the representations.
I agree. In fact, I also hold the same view. Vijay, if you want to add anything on this aspect.
Yes, I agree with Manojji and Sudhirji that auditor will perform procedures, then only he can comment on something. But even if auditor perform all these procedures, this will form the part of representation letter.
Right. Manoj sir, there are a few members who want a guidance that of course this kind of an enhanced requirement to verify the disclosure in Schedule 3 as well as the disclosure in the auditor report order, there's going to be additional effort on part of the auditor. So they are saying that they are wanting a guidance. Are these efforts going to be significant enough? Should they talk to the client for the extra time that they will be required to spend? What will be your advice to the auditors?
I fully agree, Sanjeevji, that these are new requirements which have been brought in by the government, and therefore it would take certain amount of time, additional amount of time for the auditors to comply with the reporting requirements, carry out the additional audit procedures, satisfy themselves, document them, report them. So this is going to result in an increase in the audit cost. If we are to talk about it from the cost and benefits from the work which is required to be done, there certainly it is going to increase the time required, cost required to do it, and therefore suitably the members should take it up with the auditees that this is a compliance requirement which has been brought in, and therefore there is going to be an additional cost which is required to be incurred.
Vijay is smiling. Vijay, you want to respond to this?
No, Vijay will elaborate the industry perspective because it's an industry, he knows more difficulties.
So when this is the matter of the cost, so all management will say, okay, you perform the procedures whatever you want, but please do not ask for any increase in the audit fee.
So that is why we have audit committees, and we'll go to the audit committee. It should not be high. It should not be unreasonably high, and at the same time, it cannot be too low.
Right. So that's interesting. So I think, Prasannaji, we can go to the next question for Vijay.
I got the same query. I'm just slightly modifying. Regarding the enhanced disclosure requirement Schedule 3, do you think what is the time, Vijayji, what kind of time frame may be required to comply with these enhanced disclosures, number one? Number two, do you think it requires changes to make the IT systems and the internal control aspects also in the company?
So on disclosures, on additional disclosures which are required, like aging of trade receivable, trade payable, and then within aging, you need bifurcation between the disputed and non-disputed. Of course, it will take time to configure or reconfigure IT system, because now we have certain type of grouping which is in compliance with Schedule 3, current Schedule 3. Now this needs to be reconfigured. Otherwise, it will have manual intervention. Like at the year end, you will do all kind of JV entries and all. So it is always better to do the reconfiguration in the beginning itself. So, but reconfiguration will take time. In case of trade receivable and trade payable, in ERP, all entries are interlinked within the production system, production and sales system. So it will take time. I can't say how much time is required, but at least I believe it will take a couple of months. But it is not only accounting; it will impact our market, the sales function and purchase function as well.
Right.
So
thanks,
I think the question will be disputed and undisputed. There will be dispute with the auditors on this classification, dispute and undisputed. How you will classify what is dispute, what is undisputed. Like if there is some negotiation going on with the client and they are not giving the balance confirmation. So whether you will say it as a disputed or undisputed amount, or you will take the legal definition of dispute. If there is any legal case going on, then only it will be disputed. So again, there will be some discussion. So there will be some dispute with the auditors on this aspect of dispute and undisputed.
So thanks, Vijay. Let me ask this question to the auditors.
I think Vijay is more concerned with auditors.
Vijay has been an auditor for a fair part of his professional career. Let me ask this question to the two auditors that we have. As Vijay said, for trade payable and receivable, a separate classification is to be given for disputed dues. When will you consider the dues as disputed?
Yeah, so I don't believe that this necessarily has to be a legal situation, or that the dispute has to be legal. I think there can be commercial disputes as well. And I think the biggest evidence of dispute is obviously the age. And, we've had this classic test historically of whether it's a willingness issue or an ability issue. And I think if it's an ability issue, either for you to pay or for your debtor to pay you, then clearly it's not a dispute situation. But if it is a willingness, and the willingness is backed up by reasons, correspondence, and as you inquire into the age of debts, you come to know that there are topics which are either of difference, why there are payments not being happening. I think that would given a commercial dispute, in my view, will qualify as a dispute in that case.
Right, Sudhir. Manoj Fadnis, sir, your views on this, and sir, also there is, there is additional point by Yashwant that disputed trade receivable covers where there is dispute going on before any court or arbitration, or does it also include different, if there are any differences in the balance confirmation, whether that will also count as a dispute?
So one is, I agree with what Sudhirji mentioned, that it need not be nearly necessarily a legal dispute. And the examples what you mentioned are good examples in terms of understanding where there is a dispute or where there is not a dispute. In context of trade receivables and both in trade payables, what would generally happen is that where there is a balance confirmation, and the balance is being confirmed, so there is obviously no question of a dispute. But where the balance is not being confirmed and payments are not being received, then these are the cases where the auditors will have to perform additional audit procedures if it is being claimed as undisputed. If it is being claimed even by the company as disputed, then there is no difference of opinion. But if you find that certain payments are not coming forth, there are, say, payments of earlier years not coming through, but subsequent payments are coming through, and the company still claims that the earlier years payments are not disputed. So merely on the basis of the management representation would not suffice the purpose of the audit, and the auditor will certainly have to go into, will have to perform additional audit procedures to satisfy himself that it is really undisputed. And in many cases, there would be disputes, and therefore, because of the disputes, the earlier payments have been stuck up. It could be on account of rejections, it could be on account of several other reasons for which the payments are not coming forth. And if the parties' accounts have not been properly reconciled, if not properly balanced, then there are good reasons to believe that either the payments are in dispute, which is what he mentioned about willingness and ability to pay, and therefore one will have to take a very rational decision in such cases. Also, Sanjeevji, added to this would be the distinction between what is a MSME and what is not a MSME. Now, MSME has been, last year has been amended, and it says it is related to the investments and the turnover. And those threshold limits have been revised. Now, the interesting questions which would arise, and one would look to guidance from the institute, which would of course be coming through in due course of time, is whether MSME which is registered as a MSME, is it to be considered only as a MSME, or a MSME which you know is a MSME based on its investments in plant and machinery and turnover, would you regard that as a MSME? So the question whether it necessarily is required to be registered as a MSME, and such issues would also arise when one looks at whether it is a dues to a MSME or a dues not to MSME. Hitherto, what had been going on is that the companies would ask for confirmations from the suppliers whether they are registered as MSME, and if they are not informed, they would not be considered as MSME. So these are practical and practical issues which would come up in terms of this kind of a reporting.
Sure, sir. We will certainly come out with the guidance. In fact, when you talked about MSME, I'm also happy to share, sir, that the council has approved, and today we have announced an revised applicability criteria of accounting standard for the MSME in the non-corporate sector. So the accounting standards requirements have been simplified, particularly for the micro and small non-corporate entities. There were very extensive outreach programs which I did last year. And based on this definition of micro, small, and medium given by the government, we are more or less aligned with them, rather taken some more liberal view on that. And now we are categorizing the non-corporate entity into level 1, level 2, level 3, and level 4, because the last definition was given in 2006. So we thought it's 14 years now and 15 years. There's a time to revise, and we have significantly enhanced the limit, which will bring a lot of relief to the small and mid-sized practitioner. This announcement has been posted today itself, so I thought that let me share that as well.
That's a wonderful thing which the council has done. And Sanjeevji, I know you are personally, you and Prasanna and others were personally involved in terms of the outreach programs of the board last year. You had several discussions with the membership and with other stakeholders. So it is a good effort. It's a very good effort which the council has carried out. I may just add that when the first time this was brought in by the institute, by the ASB, in terms of level 1, level 2, level 3, was a period of time when even the MSME Act was not there. So as you rightly mentioned, MSME Act of 2006, and this announcement came even before that. So it was at a point of time when there was no definition for what is a small, medium under any of the laws. And on the basis of the best possible parameters, borrowings, turnovers, net worth, etc., these criteria were evolved at that point of time. And therefore, it is good that we are harmonizing these criteria with what is there under the MSME Act, so that the law is always supreme. And it is good that you have, as you said, aligned our requirements with what is prescribed under the law. One more aspect which requires discussion at a larger level is today under the Micro, Small and Medium Enterprises Act, a turnover up to 50 crores is considered as a small entity, whereas under Companies Act the limit is 20 crores. Now the discussion which should arise at some point of time is whether two central laws should be defining a small entity differently. One defining in terms of investments and turnover at 50 crores, and the Companies Act defining it at 20 crores. And there could still be a merit in having different norms, because one is which is generally for all entities, and a smaller limit is there for a corporate entity. But these matters should be discussed on forums, and suitable views should be taken.
That's a very valid point, sir. Very valid. Moving on to you, the disclosure requirement relating to the capital work in progress are fairly extensive now, and there is a separate disclosure requirement for any capital work in progress which are overdue for completion. Do you think this will bring in more transparency, and do you think this will also trigger more cases of impairment testing? Because if there is a separate disclosure that these are overdue for completion. So what's your view on these two aspects relating to CWIP?
So, Sanjeev, the evaluation of capital work in progress, this, whether it is impaired or not, these are amongst important areas of judgment that auditors have already been applying. I think what this does is it puts that discussion out into the public domain. Increasing, earlier we had the requirement for key audit matters. Now, if you had a capital work in progress, which was large, has not been capitalized, it's likely it may have been disclosed by the auditor through the key audit matters also as being one of the important estimates that they have made. So personally, I believe that if the audit procedures have been done correctly in the past, then I don't think that this should create any additional impairment indicators. I think it only brings into public domain information which the auditor has already been factoring in the context of their audit. So I just think it gives more information to readers. It should not create it is not a new trigger, obviously, for impairment.
Sure. Thanks, Sudhir. Manoj Fadnis, sir, your view on this, plus a member, our esteemed member from Mumbai, Harsh, he has also asked a question that, giving an estimated time completion schedule for overdue CWIP, does this amount that an auditor is certifying the projected figures?
Well, the timeline is a timeline which is given by the management, and it is certainly not an auditable estimate in terms of what timeline would be taken, and it would be a timeline which would be given by the management as to when they expect that project to be completed. The fact that this information, of course, which was being audited earlier, but now it is being brought out separately in the financial statements, will certainly bring to fore information which is important from the point of view of the shareholders and readers of the financial statements. And therefore, to that extent, it will add transparency in terms of what the company is doing.
Right, sir. Over to you.
So if you allow me, can I add on this CV part?
Yeah, there is a question which is there. I think Prasannaji would like to ask you on the same aspect.
Yes, sir. See, again, continuing with the capital work in progress. So, Vijayji, do you see any practical difficulties in giving the estimated completion schedule in respect of the overdue or the delayed projects in respect of CWIP?
So I believe in all organizations, while they start any project, so they prepare time schedule as well as budget cost. And on every monthly review or some quarterly review, they assess what kind of progress is there in the projects, whether there is any potential extension in timeline or cost. So I don't see there is an issue, but what I perceive that it will be an additional price sensitive information. Of course, financial statement itself is a price sensitive information, but giving the particular detail on CWIP and how much cost have overshoot for this project, it is again a price sensitive information if you think from the large organization perspective. As and when they declare that so much of the project is now being capitalized, and in the audit report, if it comes, and the balance sheet, if it comes, that they have overshoot the cost, definitely it may impact, the capitalization also. Capitalization, I mean market cap also.
I think Vijay, he doesn't envisage any dispute with the auditors as far as CWIP is concerned.
So in CWIP, no, you need to give in the financial statement. If you overshoot the cost, if you overshoot the timelines.
Right, Vijay. Thanks. Manoj Fadnis, sir, there is a requirement particularly on the Benami property. So members have asked a question that as an auditor, this is a question by CA Naresh Shah from Mumbai. How can an auditor find Benami property, or what are the steps that he can take to find out?
Well, luckily, we are not supposed to go and hunt out for the Benami properties, if any, held by the auditee. So that is not the intention of that reporting requirement. All that is being asked in Schedule 3, and as was brought out by CA Deepa in her presentation, is whether any activity, any proceedings have been initiated against the company under the Benami Act, and if yes, the kind of details which are required to be disclosed. So I don't think auditing that should be difficult. Of course, it's not our job and not our responsibility to search out any Benami property which is in the possession of the company and registered in some other names.
Right, sir. Sudhir, would you like to add on that? As an auditor, how do you?
Yeah, I again agree with what Manoj has said, and I would only say that therefore the audit procedures are similar to what you would do for any other contingencies or litigations, because essentially you are making inquiries of the company that whether there have been any such proceedings which have been initiated. I don't think you are being asked to determine whether there is any Benami property, but whether any proceedings have been initiated.
Right, Sudhir. Thanks. Sudhir, the next question is again to you. Can you elaborate more on the requirement relating to compliance with the number of layers of companies? As an auditor, what exactly you are supposed to do?
Yeah, as I was mentioning earlier, that what is the direction of all these changes? And I think increasingly a large number of sections of the Companies Act, which, initially, if you see guidance on what are auditors' responsibilities on compliance with laws and regulations, it's largely pertain to those sections of the Companies Act which impacted the financial statements. But what we are seeing directionally is that more and more sections are being added where the government is seeking to determine whether there has been compliance or not. So as I think the professional fraternity is aware, Section 186 of the Companies Act and I think Section 2, subsection 87, they define, Section 2, subsection 87 defines what is a layer, and basically a layer is a subsidiary below the holding company, subsidiary or subsidiaries below the holding company. And Section 186 had a requirement that you should not have more than 2 layers. Now, what the requirement seeks to impose is that companies should disclose what are these layers of subsidiaries, and the auditors need to verify this. I think with increasing digitization and, in the Ministry of Corporate Affairs, I think some of this information is now clearly auditable as to what is the holding chain that a whole company has, which are the subsidiaries that they have. And I think the auditors need to ensure that there are not more than 2 layers. The sections, there is a set of rules which is applicable in this scenario. And the rules have carved out, for example, most of the financial services entities are out of the scope of this requirement, which is there. That is banks, insurance companies, and so on. Even government companies are exempt from this. So I think essentially the auditor is auditing for compliance with these requirements of Section 186 and of the rules that have been laid out in this regard.
Sure. Thanks, Sudeep. Manoj Pandit, Sunil Agarwal ji has a question. Then this relates to the quarterly returns which are submitted to the banks. What is the parameter for identification of material discrepancies? That if there is a material discrepancy in what has been submitted to the bank and what is there in the books of accounts. So first of all, what is the rationale of asking for this information from the auditor in Caro report? And then, how will you identify what is material and what is not material?
So, very important amendment which was there in Caro 20 and which was deferred for quite some time now. It was to come in, I think, in 2019, 2020, and now again it stands deferred for a year. So it is good that while the auditor is required to report upon this, simultaneously the information is also being disclosed in the financial statements. And therefore it becomes first an obligation on the company to disclose what is the information which is given to the banks and what is the information as culled out from the books of accounts. And I believe this is one very good development which the government has done, that at the start of the year, it is again brought out to the notice of the companies and the auditors that this year onwards, this is applicable. So as was mentioned during the course of the presentation, starting from 30th of June, that quarter onwards, whatever information is being provided to the banks would be required to be compared with what is there in the financial statements. The companies would be disclosing it in the financial statements audited by the auditors, and also the auditors putting it in their Caro 2020 report. So that is the need to have this information both in the financial statements and reporting by the auditors. Insofar as what is materiality is concerned, is as we understand from all our auditing and accounting standards, is that it is based on facts and circumstances of the case, and that it cannot be one universal fit-for-all rule which would define what is the materiality. And the auditor would be setting the materiality levels as is required in the standards at the financial statements level, at each class of transactions, and for different heads in the financial statements to decide what is the levels of materiality which are being carried out while conducting the audit. So in that context, one will have to understand the materiality and the significant differences between what is reported to the banks and what is being reported, what is the part of the financial statements. This will certainly bring in greater discipline amongst the corporates in terms of ensuring that the information which is given to the banks is based on the financial statements. There is more accountability at the highest levels, because this now becomes part of the audited, becomes part of the financial statement. So you have the board of directors which are responsible for this, and not just the CFO, to ensure that the information is given to the banks. I think it's a good governance step in the right direction.
Thank you very much, sir. I'll request Prasanna ji to take up maybe possibly the last question to Vijay, and then we'll have one last question to Manoj Fadnis.
See, Vijay, nowadays everywhere the topic is only CSR. Where also in the institute also a constituted separate committee for CSR committee is there. Now, how do you ensure that the CSR funds which are given to a trust or any other donee are utilized properly?
So, if I can take example of my industry, so in my company, I mean, so our group performs CSR activity through a trust, and we all 40 legal entities contribute the amount to that trust. And on a quarterly basis, like our audit committee and board meeting, we have our CSR committee, which all tracks whatever amount we have given to that trust and where they are spending. And if required, we direct them where this amount to be spent. So again, on this CSR activity for large organization, again, I don't see any challenge. So it is again the matter of all the documentation, that how strong documentation you are maintaining. And of course, now because the certification of the CFO is also required to the board, that whatever the CSR amount has been given has been spent for that particular activity. For that, now activity may increase, or we may, involve some third-party consultant to review the accounts of that CSR trust. That may happen.
Yes.
And Prasanna, if I just add to this, I've heard discussions going on that the chairman of the CSR committee should also be the chairman of the trust, which is being managed, or which is being set up by the companies or the group of companies, so that the chairman of the CSR committee, as chairman of the trust, would have operational controls in ensuring that the objects of CSR are properly met.
To meet the common objective.
Common objective.
Yes. Yeah, that is very nice information. Yeah.
So thanks, Vijay. Sudhir, a final question to you, because we are just left with 4 minutes. And I can tell you that right now there are 10,377 hits. Probably this program has seen the maximum number of audience, 4,401 at this point of time. So compliments to all of you. Sudhir, do you see any additional audit step that an auditor will be required to undertake for ensuring compliance with the new requirement relating to the CSR? And any concluding remarks in addition to that?
Yeah, I think this recent changes in CSR, it's a dramatic shift from, as we know, a comply or explain approach to a comply approach. And the moment compliance comes into play, and I think requirements now on Section 135 are very prescriptive, I think it becomes incumbent on the auditor to perform additional steps. And I think these steps are going to be both from an accounting perspective, but even more important is from a compliance perspective. So, for example, whether the implementing agencies that the company has used, are they registered as required by the section? Whether the funds that are required to be transferred at the end of the year to the specific bank accounts, has that been done? Whether the impact assessment has been done. So I feel that auditors will need to become probably more intrusive on the CSR activity than they have been historically there.
Right. Thanks, Sudhir. Manoj Fadnis, same question to you, and any concluding remark, because we are coming to the end of this great session.
CSR, as we understood earlier, was either spend and or disclose. Now it has become mandatory to spend, and therefore it is an obligation on the part of the company to ensure that the money is spent. Otherwise, it is required to be transferred to the separate bank accounts, as is brought out in the newly rules. And therefore, the auditors will certainly have to look into the audit of the CSR expenditure and the compliance with respect to CSR expenditure into greater depth, because earlier the CSR was part of the director's reports. Now it is becoming part of the financial statements which are being audited, and therefore the entire CSR activity will be subject to greater audit. To conclude, Sanjeevji, the large number of changes which have come in, it is very commendable on the part of the government to bring in these at the beginning of the year. So 2021, we know that when we bring out the financial statements at March 22, these are the rules which are going to apply. These are the audit requirements. And bringing out all this at the beginning of the year is extremely commendable on the part of the government, and surely shortly we expect to have suitable guidance also from the institute, so that throughout the year adequate number of programs would be conducted and sufficient awareness would be carried out in terms of the reporting requirements by the auditors. So these are all steps in good directions. The only place where I felt was a little problematic would be to implement the new accounting software rules for all the companies. That is where the government may consider that initially it may be for listed companies or large companies and not for all companies. And it would be good to give the smaller companies a pathway whereby they should also come up and have these accounting softwares and audit trails, but over a period of time. But it is certainly in the right direction.
Thank you very much, sir. Thank you. And in fact, we'll be scheduling a detailed program on a clause-by-clause analysis on these changes on 11th of this month from 11 a.m. to 1 p.m. Thank you very much for your time today. And I would request my co-chairman, Prasanna ji, to kindly conclude this session.
Yeah. Okay. Chairman Sanjeev Singhal. So it's nicely we had this program. This is the first program we're having it after the bank audit, which is largely attended by the members. Is a really encouraging factor. You know, for the trust and drive that you have to empower the members in practice, particularly small and medium practitioners, is really encouraging. I'm sure that under your leadership will take it forward to see that many more programs of this kind are conducted in future. Many viewers, so they have asked for many technical queries have been raised. I'm sure in the next program, all those queries will be answered. The committee CM Manoj Patil is honorable past president. See, always he is a very friendly person with everyone. There's a saying in English: a friend in need is a friend in deed. Is a true example of that. That's what we call him Ajat Shatru, a person who doesn't know who is the enemy. He is one of such persons. So nice that he is present here. He knows the history and geography of accounting standards, history and geography, from origin to the future. And when IFRS has come to India, that is a buzzword internationally. We didn't know the ABCD of that, even the abbreviation. He is the person who started the entire work, and it resulted in Indias. And there's a travel now toward the Indias, convergence of accounting standards also towards Indias. So, sir, thank you very much for dealing with the practical aspects of the amendments and also giving a roadmap for the institute to react and empower the members. So, thank you very much, sir. Thanks a lot. The CS Sudhir Soon, as you know, I heard him earlier also many occasions, is a knowledge bank. And corporates particularly is a comment over the subject, and the effectiveness with which he answers is very excellent and amazing. So thank you very much, sir, for your participation as a panelist. Vijay, it is a good combination our chairman has thought of to keep a renowned personality from the industry also. So he has been talking about what are the issues that may arise between the auditor and auditing, arising out of the amendments. So it's very nicely as presented. And also, we all the members in practice will thank Vijay for reminding us that because our responsibility and duties are going up due to these amendments, he has reminded that we should also seek enhancement in the fees. Thank you very much for reminding us. See, Deepa Agarwal, she made a very good presentation. She set the tone for the entire deliberations today. And out of the queries received, at least 1,040% of questions relate to only one aspect. That is, please share the PPT. So that is a nice presentation made, Deepa. In fact, everyone wanted it. As our chairman said, we'll certainly share this PPT with everyone for their companies. Thank you very much. Thanks a lot. Look forward to meet you in the next program with your encouragement. Thanks.
Thank you. Thank you.
Thank you. Thanks, everyone. Thank you.
Thank you, sir.